The proper tax planning will save your business, will save your household, will save your marriage, and will give you access to more opportunity. No joke. After today's presentation, I want you to walk away with three things: increase profits, get more cash flow, and pay less taxes. And I'm going to flip those around. You're going to pay less taxes first so that you can increase profits, increase cash flow, and at the end of the day, keep more money in your pocket. That's the whole point of running a business and running your lifestyle and running your household and running your life. It's not to work harder, it is to work smarter. And I can't wait to share this with you because I believe that this will strongly impact your life and change how you operate your mind, change how you operate your business, and change how you operate your household. So here we go. We're going to talk about tax planning as a lifestyle. It's tax planning and strategy stacking the strategies. This is super, super cool. So who am I? I'm sure you've heard a lot about me. I'm not only a mom and a wife, I've also published many books. I've started many podcasts, been featured on news channels, and I've have over 2 decades of experience in tax planning, and it is my passion. And as a CPA, I have watched businesses struggle and fail. I have watched families struggle and fail. And I don't want that to happen to you. In fact, I don't want that to happen to me. So the biggest thing is practicing what we preach. So several years ago, actually about 10 years ago, I realized that I was giving incredible advice to people and they were skyrocketing, they were soaring, they were traveling, they were living the life of their dreams, and I was stagnant. And I think this happens to many of us, that stagnation. So, what I vowed to myself and I vowed to all my clients and my family, my colleagues, my friends, is that I have to be the example of what I preach. And here it is. When we start tax planning, we have to start with something reasonable. So, we always start with $10,000. I bet you, hands down, that when we talk and I'm able to look at your business and then your household, we're going to be able to save you $10,000. I have not yet come across a situation in my 2 decades of being a CPA in this industry in tax planning. I have never seen an example where that wasn't possible. And in a moment, we're going to introduce what stacking means and different tax strategies that you can utilize. So let's use the $10,000 for stacking, for example. Let's say we figure out several ways to decrease your taxes on your business. Check mark. Let's have a goal of $10,000. And then let's find different ways where we can increase your cash flow personally in the amount of $10,000 or save $10,000 worth of expenses. If we stack that together, we already have $20,000. And what can you do with $20,000? And in certain situations, that could be $200,000. That could be $20,000. That could be $2 million. It just depends what level you are at financially and what resources you have. But what I want you to walk away with is that anything is possible. Anything is possible as long as you want to make the change now. So just in 2025 alone, our family traveled to places that we never thought we'd travel together. And we traveled on a budget. We weren't stressed about money. We planned it in advance. We traveled on credit card points and we went to town with what we wanted to do. So the first thing I ask you is, what is your definition of financial freedom? That definition is going to dictate how you're going to approach tax planning within your business and tax planning on an individual level. What is your definition of freedom? My definition of freedom is being able to travel and experience the world in different cultures and different food and having my kids see that as well. Having my kids see that at the age of 5 or 7 or 11 instead of at the age of 45, right? I want them to live in a world, in a lifestyle where traveling is normal and traveling to exorbitant places anywhere they choose. I want them to grow up as normal, that to be norm. And once that is their norm, they're going to create their lifestyle and their financial futures and their definition of financial freedom in a different way than we have, and in a much quicker way. Not decades into our lives, they can establish it right now. So giving them that gift to me is invaluable. Okay. So now going back, time value of money, right? How is saving $10,000 going to benefit you? It really doesn't sound like a lot to some, but it's a lot of money for others. And perspective here is key, right? $10,000 that can buy you a trip, that can help you pay off credit card debt, that could help you get a loan, that could be a down payment for your first home, that could be a down payment for your second home. That could be a down payment for your boat. That could be money that you just put into a savings account or buy some crypto. You can make other investments. You can recreate your life. And if we are able to get our hands on that money, we flip the control. We flip the control back to our own narrative and what's important to us. So, for example, in my Fall in Love with Money books, we talk about just taking back that ownership of what we feel is important for financial success, what we feel is important for our future, our success. And we're able to create a process, and we've created a process. There's a whole workbook where you can dissociate yourself from the programming that you've received about money. And money is typically a programming that you receive with your family first and foremost, and then it's supported by who you surround yourself with, and then it's supported by the economy, by media, and by other institutions. So that first and foremost, that mindset up here has to change. It must change. There is no other way. It must change. And when it does, we can play with money because money at the end of the day is just energy. And I'm not going to go into that right now because this is more about tax planning, but I'm planting that seed because when we're able to assimilate how we react to money, how we use it, how we attract it, how we utilize it and deploy it, that's when the magic happens and everything starts working in our favor so that you can play more, give more, be more, keep more. All right? I want you to know that there is a light at the end of the tunnel. And then with prestige business enterprises, we want you to have discipline, lifestyle, and stacked tax strategy. When all those are combined, tax planning is no longer in a little box where you check off tasks. Tax planning becomes an all-encompassing lifestyle where There is no line in the sand, and especially no line in the cement in how you approach tax savings because we can do it in multiple ways. So, what is the problem, right? Why don't we do this? Why can't we just change our minds right now and make this happen? Well, taxes are the third largest household expenditure after housing and transportation. However, it's the first one we can regain control of and pay less of. 93% of business owners overpay their taxes, even ones with extraordinary CPAs. 8 out of 10 entrepreneurs who start businesses fail within the first 18 months. This is a scary statistic. And our household debt is insane. With mortgages, home equities, auto loans, credit cards, student loans, tax bills, back taxes. But taxes, I'm going to remove from this right now because taxes are something you can control and have fun with. Also, note this, $8,000 is the median savings account balance back in 2022. $8,000, that's it. So imagine if you could increase that by $10,000 right now. I want you, pay attention to this right now. I want you to put in 20% effort and get 80% of the results instead of spinning your wheels and expanding 80% of your energy to get a measly 20% of a result. That's garbage. That's old news. That's yesterday. That's not happening anymore. 20% effort, 80% results. That is what we want. We have what it takes to take what you have, has been the suggested IRS motto. I've heard that multiple times. Ronald Reagan says the taxpayer, that's someone who works for the federal government, but doesn't have to take a civil service examination. Albert Einstein, the hardest thing in the world to understand is the income tax. I laugh at this because, yes, in some cases, if you take it verbatim, if you just read the black and white code, it is difficult to understand. But in practice, with someone that understands the code and understands how to utilize it to create your benefits, pay less taxes, increase cash flow, keep more money in your pocket, that is the trifecta that makes businesses run, that makes households run. Calvin Coolidge, collecting more taxes than is absolutely necessary is legalized robbery. I agree. I absolutely agree. And then going back, I only want you to put in 20% effort to get 80% of the results. That is the Pareto principle. All right, so what do I mean about tax stacking? Tax planning stacking. All right, let's go into some definitions here. Marginal tax rate is something that we deal with every single time we file our tax return. You make more income, you get into a higher tax bracket. There's your marginal tax rate and your effective tax rate. Your effective tax rate is based on what tax margin you're in. Your marginal tax rate is a combination of all of those to give you that final percentage that you're being taxed on collectively on all of your income. And there's the IRS rate and there's the state rate wherever you live. Fortunately, in Florida, we don't have a state income tax, so we only have to plan for the IRS tax. However, if you live in high tax states like California, Illinois, New Jersey, New York, your cash flow is going to suffer more so than those that don't live in income tax states if you don't have the right tax planning. So your marginal tax rate foundation, There are three components here that every single business owner must maximize to know and understand and be sure that you're maximizing every cent and every dollar within your marginal tax rate. Those three components are your general ledger optimization, your payroll, which is your reasonable compensation, and your entity structure. These three layers are the foundation of tax planning for your business. And these three foundational layers, if done incorrectly, will trickle down to your personal household and have a negative effect. If done positively, in a way that I'm suggesting here, it will trickle down to your personal life and give you an extraordinary positive impact. Remember, pay less taxes, keep more money in your pocket, increase cash flow. Yes, 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 and yes. Okay? All right. So in a moment, I'm going to go into some other principles here, but the general ledger optimization is essentially taking your business and very specific industry that you operate in, and we're dissecting it. In general ledger optimization, we want to make sure you're maximizing all your expenses. We're making sure you are not duplicating transactions, you're not overstating your income, and that you're not overstating your expenses. So, having the proper financial records with your profit and loss statement, your balance sheet, and your general ledger, that is the key to knowing your numbers. The numbers don't lie. We want to make sure we are looking at your numbers so we know where you stand. And knowing the truth of where you stand financially within your business, we'll know which direction we have to take and how long that process will take for you to get the goals that you want. All right. Then there's payroll. How do you pay yourself? What is your reasonable compensation? I don't want you to overpay yourself because then you're overpaying in payroll taxes and Medicare and Social Security tax. So we want to find a reasonable compensation within your industry to be able to support the minimum requirements that the IRS has for you to take a salary and also the cash flow you need for your home. Going back to the general ledger briefly, there are two parts. As a business, just being in business in general, think of this as an umbrella, right? Being in business in general, that umbrella portion that saves you from the rain when it rains, you don't get wet, you're able to take all the general business expenses that any business can take. Bank service charges, dues and subscriptions, travel, advertising, marketing, meals, office expenses. Okay? And then the handle of that umbrella is your very specific industry that you operate in. In that specific industry, certain industries will be able to take additional expenses that other industries cannot take. For example, if you're a dog groomer, you'll be able to write off dog supplies, pet shampoo, pet hairbrushes. But if you're a CPA, such as myself, I'm not in the dog grooming industry. I can't write off everything that a dog grooming industry can write off. However, both of us, me as a CPA in a tax and accounting firm, and the dog groomer business, we can both write off office expenses and travel and electricity and advertising and bank service charges and travel, right? So when you are in your specific niche, specific industry, you may be able to have access to additional expenses that others would not. Another example is someone in modeling, right? Someone in modeling will most likely be able to deduct their makeup, their hairbrushes, their visits to the salon, their facials, and everything. But once again, comparing to being a CPA, tax and accounting, I can't write that off because it's not in my industry. And when we talk about industry specific things, we're looking at corn. And corn means customary, ordinary, reasonable, and necessary. What are the customary, ordinary, reasonable, and necessary expenses in your business, in your industry, right? So if we're talking about events, travel to events is deductible as long as it's customary, ordinary, reasonable, and necessary for your business, for what you're doing to generate revenue and create a profit. Okay? All right. So then going back to the marginal tax rate, entity structure also dictates how you're going to be taxed. And entity structure is something once you elect it and you don't change it, that entity structure will stay with you for the life of the business. You're able to change your entity structure for tax purposes. And I recommend you looking at that to make sure you're maximizing your deductions, you're maximizing your tax savings. But this is critical, and this is where most people fail. And this is one of the first pieces that must happen with your business. For example, are you a single member LLC? If you're a single member LLC, you're a disregarded entity and you're going to be filing on your personal tax return on your Schedule C. But on your Schedule C, you're going to be taxed at your marginal tax rate and you're going to be taxed at a self-employment rate for all your profits in your Schedule C business. That might not be advantageous to many people. Let's say you're a single member LLC taxed as an S corporation. You have more specific requirements that you must fulfill based on the IRS code. But when you transition to an S corporation, you're no longer paying self-employment taxes on your profits. So you're already saving 15.7% in tax just moving to an S corporation. But does it mean that an S corporation is right for you? We don't know yet. We have to dissect your specific situation. What if you're a multi-member LLC and you want to be a partnership? That can be advantageous, potentially. It requires other due diligence, but if you're looking to have investors come in and out, partners come in and out, it's pretty fluid. It's less restrictive than the S corporation. Or perhaps a C corporation is best for you. Are you looking to sell down the road within 5 years? Guess what? If you are, the 1202 exclusion on the C Corp is going to save you because when you sell your business in a stock sale, you're going to be able to save up to $15 million in capital gains. Okay? So, food for thought. Every single entity structure is going to provide you with different requirements that the IRS requests. And also, some more than others will give you more tax savings. All right. And that also depends on your personal situation, your business situation. Because one entity structure for one business, if you're an S Corp, may be more beneficial than a C Corp versus another business, a C Corp is more beneficial than an S Corp. It truly depends on what you're looking to accomplish, what your exit plan is, who your partners are, and what the goals of the business are. Okay. Then we have high margin discount multiples. And this is really, really interesting because here, after the marginal tax rate, we went into something that only accredited investors will be able to participate in and play with. Okay. And accredited investors are individuals that make over $200,000 in W-2 wages in the last 2 years and expected to make the same if you're single, or $300,000 if you're married filing joint. And if you don't qualify via W-2 wages alone, if you can prove that you have more than $1 million in equity personally, excluding your personal residence, you would qualify as an accredited investor as well. There's some of these concepts where you don't have to be an accredited investor, but you would have to meet some other requirements. But I wanted to throw that in there because I don't want you to think that anyone could get into these high margin, high multiple tax saving situations, but they are there for you. So a high margin discount multiple, and the best example is getting to an oil and gas investment or a real estate syndication. And I'll use oil and gas as an example here. So for every dollar spent, your taxable income is going to be reduced by a zero point 0.6, zero point 0.7, zero point 0.8, or zero point 0.9 cents on the dollar, as opposed to your marginal tax rate. When we look at your general ledger payroll entity structure, your tax savings are only going to be at your marginal tax rate. And that could be anything between 10%, 15, 17, 23, 27, 30%. Okay? Depending on what combination of state and IRS marginal tax rate you have. These are going to give you a higher return on your tax savings. So in oil and gas, if you make a $100,000 investment, I'm just using this as an example because once again, every single investment is going to be a little bit different depending on what company you work with. But many times we'll see a 90% return of tax savings in year one. So if you make a $100,000 investment in year one, you'll get a 90%, you'll get a $90,000 deduction from your taxable income. That's huge. So all of a sudden now you went, let's say you had a $300,000 AGI, meaning $300,000 worth of adjusted gross income on your tax return. And now you have a $90,000 tax reduction, excuse me, taxable income reduction. Now your 300,000 taxable income is now only $210,000 taxable income. And then your marginal tax savings apply. This is a big mover for people. Truly, truly impactful when you're looking to save the dollars and cents in the time value of money so that you can have to pay smaller taxes this year or get that refund. And remember, we're only looking at the $10,000 initially. This $10,000 is easy to find in your tax savings. And then another one are the multipliers. And the multipliers are other investment type structures, also only for accredited investors, that are more risky and they provide heavier weighted results. There's charitable LLC multipliers. There's solar credits. There's opportunities for Section 179 investments. There's so many different ways we can stack this. It's very, very interesting. So in the multipliers, for example, as opposed to the marginal tax rate, right, where for every dollar spent, you save your marginal tax rate, the high margin discount multiples, for every dollar spent, you get anywhere between 60 and 90% reduction in your taxable income and then your marginal tax rate savings. In multipliers, you get a 5x, 7x, or 10x multiplier in your reduction of income, and then your marginal tax rate applies. So in some of these examples, a $50,000 investment with a 5x multiple will give you a $250,000 deduction. And then that $250,000 deduction, going back to our $300,000 AGI example, 300 minus 250, now you only have $50,000 of taxable income. And then we apply your marginal tax rate. Do you see where this is going? There are so many opportunities. You just have to know who to talk to. And we have to make this as CPA professionals more common for our clients because we are not providing them a service of tax planning if we're just looking in the rearview mirror and filing old tax returns, right? We want to be value drivers. So now think about this, the tax stacking model. We can combine your general ledger optimization, reasonable compensation, your entity structure with either a high margin discount or a multiplier, and bam, you have tax savings. And when you have tax savings, you have more cash flow. And when you have more cash flow, you keep more money in your pocket so you can do with it what you want, not what the IRS dictates you to do. Are you with me? Are you following me? Is this making sense? Okay. Is this making sense? And you can always contact us. You could always contact our office to see what works best for you and see if there's anything we can do to help. In our description notes below, you'll be able to contact our office to see if we are the right fit for you or if there's something maybe you're missing that you want to talk about. Okay? I want you to be fully empowered with your money. The tax code is there. The opportunities are also there. Let's utilize all of that to get you on the right track. Going back to the tax planning lifestyle, when you approach tax planning, it is absolutely critical for you to have a clear goal, a clear vision for what you want your business to do and accomplish. Additionally, a clear vision and a clear goal for what you want to do personally. When we're able to take your business and marry it to your personal goals and vision and resources and accomplishments, we're able to move the ball much, much quicker. There's also something else here in this strategy stacking that I'd like to address. There's also new opportunities. So there's really a fourth piece. The new opportunities can be, follow me here for a moment. Let's say you maximize everything in your business and everything in your personal life. And let's say one of your personal goals is to own real estate, whether it's residential rentals or commercial rentals, whether they're Airbnbs or long-term rentals, mid-term rentals. It's up to you. This is just an example. What if you maximize everything else, you have the tax savings, and now you can create a new opportunity for yourself that also creates tax savings? Creating new opportunities, like getting into a real estate, allows you to take advantage of accelerated depreciation, which is a cost segregation study. And in that vein, you're able to accelerate more expenses in the property that you own to reduce your taxable income and then take advantage of your marginal tax rate. Reducing your taxable income, as a reminder, is going to reduce your effective tax rate and your marginal tax rate. That can also be a part of your tax savings stacking. Now, I would be remiss to say if I didn't include some really cool toys in here. And I don't always get into this, but let's say you've maximized the marginal tax rate, high margin discounts, the multipliers, your opportunities. What if you have really cool toys like yachts and airplanes, collector's cars, boats, motorcycles? Have you thought of maybe turning that into a business opportunity? That, yes, it's a new opportunity, but also I kind of look at that as the fun, what can we do with your toys? Okay? Those in themselves are not tax strategies, but they are and can be tax strategies if you use them in the right way, in the right manner, with the right intention to be able to get yourself into the right goal that you have for yourself and your business. All right, so I want to share with you just a few examples here because I think this is going to drive the point home. And these are actually real live clients whose names I have changed to protect the innocent. But I want to share with you the tax savings that they have. Okay, So if you're watching this, it's going to be easier for you because you'll also have the PowerPoint slides. But if you're listening to this, I'll try to articulate this in the best way I can. So Ryan, for example, had $115,000 of business profits and is a single member disregarded LLC. His tax bracket is 24%, but because he's a single member disregarded entity, single member LLC, he's also being taxed at a 15.7% payroll tax. And that's just for IRS. It's not even including the state. So his tax at $115,000 is $45,570. Now, we recommended for him to elect into an S corporation for many, many reasons. And the tax savings happen to be a byproduct of those reasons. But he's still in the 24% tax bracket, but he no longer has the self-employment tax of his entire profits. So now his tax is $16,320, tax savings of $29,000. That's insane. Just by changing your entity structure. And guess what? When you change your entity structure, those tax savings are going to follow you year over year over year over year. So imagine if he had his business for 10 years and he never changed his entity structure, he could have potentially lost $29,000 in tax savings every year. That's $290,000 over the last 10 years of missed tax savings just because he didn't elect the proper entity structure. Am I driving this home? Okay. Are you doing this? All right, let's go to the next one. All right, Michael. Michael came to me and he says, he's very excited. And he says, hey, Marta, I have a $550,000 salary. And he was so giddy and so happy. He's like, I am making it. I am loving this. I am flowing. Everything's amazing. And I looked at him and I asked, why would you pay yourself $550,000 in W-2 wages? That doesn't make any sense. He got deflated a little bit, and then we went into some examples. All right. I asked him the first question, why 550,000? And he very confidently said, I need 550,000 annually to substantiate my household lifestyle. I get that. I totally got it. And I knew which direction we needed to go here. He needs $550,000. He's the only breadwinner in the house. Okay. He has a large family, a beautiful stay-at-home wife, and he just needs $550,000. But taking it all in W-2 wages is not the answer. He's taking it all in W-2 wages. So the $550,000, the payroll taxes alone are $16,000. His tax bracket's 35%. So that's $126,000 in tax. His total tax between the payroll taxes and his marginal tax rate is $142,000. Okay. So then I said, all right, we got to do a few things here. And this is a combination that it was truly magical for him. One, we performed a reasonable compensation. Remember that foundation? General ledger optimization, reasonable compensation, entity structure. Okay, we're doing it right here. This is a perfect live example. We did a reasonable compensation study on him, and we said you only need to pay yourself $93,870 in payroll based on your very specific reasonable compensation report that would be supported by the IRS. So the tax there is only $7,000 instead of $16,000 for your payroll. Then we changed him into a C corporation because he was an S corporation before. All right. So in a C corporation, he's also on the board of directors. So on the board of directors, he earned $60,000 stipend in 1099 income. But in order to earn that stipend, being on the board of directors, because he has very specific duties he has to perform, we were able to find and determine and substantiate over $37,000 of expenses that he incurred to create that $60,000 income. So after we applied that, he only had $22,000 of taxable income. His self-employment tax is at only $3,400. Keep in mind, we're looking at cash flow. Then we realized that he had to repay himself a loan from the business of $150,000, which is not taxed as long as you don't exceed your basis, but that's a conversation for another time. So zero tax there. So in summary for now, $93,000 payroll, $60,000 stipend, $150,000 loan. We're getting very, very close to the $550,000 cash flow that he needs. And then we gave him the rest, the remainder, to get him to the $550,000 in a $146,000 qualified dividend. As a C Corp, you're able to pay yourself in dividends, and those qualified dividends are at 20% tax rates, not at his original 35% tax rate. So at the end of the year, he was in a 24% tax bracket, and he only paid $67,000 in taxes instead of $142,000. That's a tax savings of $75,000. Imagine doing this for 10 years and looking back, 75,000 times 10, he lost $750,000 just by not doing the three foundational pieces: general ledger optimization, reasonable compensation payroll, and entity structure. $750,000 he lost over the last 10 years. That is absolutely unacceptable to me. And with these examples, I hope you're able to walk away with a nugget that makes sense to you, if not all the nuggets, right? Ideally, if you can stack everything, you're going to change your life. You're going to change your business. You're going to change your household. But if you walk away with one nugget, then I've done my job right. As a reminder, corn is customary, ordinary, reasonable, and necessary. That's essentially the expense formula that you must follow as a business owner. All right, so then let's go to Natalie. And Natalie has 2 slides here. Natalie came to me very shy, very scared of the IRS. Very scared of the IRS. She did not want to cross a line in any direction, any way, shape, and form, because she felt like if she was lowering her taxes or adding expenses to her business to reduce her taxable income, she thought she was doing something wrong. Somewhere, somehow, she was programmed to think that she was doing something wrong. And then I met Natalie, and then we had a discussion. We had a discussion on the tax code that, by the way, is written for the taxpayer and the business owner so that you know what steps to follow to reduce your tax liability. The IRS wants you to pay your taxes, but they don't want you to overpay your taxes. They want you to pay your reasonable share. And me too, I want you to pay your taxes, but I don't want you to pay $1 more than what you're required to do, period. So Natalie came to me, she had $150,000 revenue. Her tax rate was 22%. So just by reporting $150,000 worth of revenue, she paid $17,500 in taxes. But then Natalie and I sat down and I felt bad for Natalie, but I also wanted to tiptoe gently around the situation because she just didn't know better, right? I asked her, hey, Natalie, did you advertise for your business? And she said, yeah, of course. We do Facebook Marketplace advertising, and it was like, over $4,000. Okay, so I jotted that down. Do you use your automobile? Do you drive your auto for your business? Oh, yeah, absolutely. We meet clients. We go to lunch with them every single week. Okay, so I knew we had to do an auto worksheet with her. Hey, Natalie, does your bank charge you service charges to have your bank account open? Why, yes, Marta, they do. Okay, noted. As I'm explaining this, note where I'm going with this, okay? Continuing education. Hey, Natalie, did you have to take any continuing education for she's actually a real estate professional, for your real estate professional license? Not so much, she says, but we did a little bit. Great. I noted that. Did you hire any consultants? She said yes. And I'm going to go very quickly down this list. Do you have any dues and subscriptions that you subscribe to every single month to help your business grow or that is required for your business? That meets corn, customary, ordinary, reasonable, necessary. She said, yes, absolutely. So she's jotting these things down. And as we're going through this, I see the light bulb going off in Natalie's head. And she's like, Marta. I'm like, yes, Natalie. I think I may have overpaid in taxes. I said, yes, Natalie, you did. You absolutely did. Do you use your home office exclusively for your business? Why, yes, I do. Did you gift anything to your clients? Yes, I do. Do you have merchant service fees to collect on credit cards? Yes, I do. Are you networking, marketing? Do you have any business meals? Do you pay employees payroll? Yes. Do you travel? Do you pay for airfare and lodging and tolls and car rentals? Yes, 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 Natalie says. Well, after we listed all that, Natalie did go through her records and provided me with the actual numbers, and her $150,000 profit was reduced to $58,000 because we found $91,000 of actual legitimate business expenses that she wasn't taking in the past. That alone moved her down to the 12% tax rate. Her taxes were only $3,200, a tax savings of $14,000. Multiply that by how many ever years she was in business, let's say 10, it's $140,000 over a 10-year period. That's unacceptable. It makes me very sad that Natalie wasn't given this advice in the past. But wait, there's more. Okay. So this wasn't in the same year, although we could have done this in the same year. The year after, Natalie legitimately hired her children. And when she hired her children, she paid them a reasonable salary for what they were doing and the hours that they were working. So she paid them an additional $13,000 each to work officially for W-2 wages. She also used the Augusta strategy, which is the ability to rent out your own personal residence for business purposes for no more than 14 days a year. And the business gets to pay you a reasonable rent, and there's a formula for that. So just, don't take this with a grain of salt. There's an actual process in how you determine the Augusta strategy amount. But she was able to have her business write her a check for rent in the amount of $25,200 for all the times the business used her entire home throughout the year. So that became a business deduction for rent, but she didn't have to report that as taxable income. Excuse me. She had to report it because it's a reportable transaction, but it's not a taxable transaction. So she was able to increase her business expenses by $13,000 for child one, $13,000 for child two, $25,000 for additional rent. And then I did throw in a traditional IRA there. It's misplaced there, but I was trying to just show an example here. So with the additional tax strategies, she had an additional $59,000 worth of expenses added to her original $91,000 of expenses. Her $150,000 profit became a $1,200 loss. So she owed no taxes that year. This is just a small sampling of what can be done. This is a small sampling of what's important, of what you're able to do, of what your professionals should be helping you do. And this creates an entirely different ecosystem for your business and your household. So I do encourage you, there's a QR code. If you're watching this, scan the QR code, connect with our team so that we can discuss what your next steps are. And time is of the essence. The time is now because the time value of money is what kills us. if you plug in that dollar or that $10,000 and earn 6% a year over a 10-year period, that's going to grow exponentially. And that's just with 1 year of savings. Imagine if you can add that in every single time you have tax savings. That's just the start of it. That's just starting that tax savings snowball that will only grow into something larger as you nourish it, as you add and stack more strategies, as you change and pivot your business, as you add more goals or more household members into your household. Anything is possible, and everything is possible with the right strategy. So I hope this helped today. Please connect with us. And remember, pay less taxes, create more cash flow, keep more money in your pocket today.